Hello, everyone. This is Stacy Francis of Francis Financial, and welcome. We're going to be getting started in just about 30 seconds. There's a few more people that are coming in from the waiting room. And I just want to say a great big thank you for joining us today as we're going to be talking about unpacking the impact, what a Trump presidency means for your money. We'll be spending about 45 minutes together today, and this will all be recorded. So don't worry if you miss a piece here or there, because again, we'll make sure that you get that recording. All you had to do was register, which you have done if you are here, and we'll be sure to send that out in the next day or so. For all of you that are joining us today, I really want to just let you know that if you have any questions about what we're covering today, or anything about either the market, your portfolio, or your financial planning, know that we are here. So we'll give our guests just a few more minutes to join, and then we'll get started. All right, so let's get going. Unpacking the impact, what a Trump presidency means for your money. I'm Stacy Francis and excited to be here to talk to you about some very important pieces for the market, for the economy, for your wallet, for your pocketbook. I'm a certified financial planner, a certified trust and estate specialist, as well as a certified divorce financial analyst. I am the founder here of Francis Financial, a fee-only fiduciary wealth management firm. Our superpower is working with individuals who want to make the most of their money and have a financial plan that gives them peace and prosperity and peace of mind. We have over 20 employees, almost all women, interestingly enough, which is kind of odd to see in the financial industry. But again, we are all committed to particularly helping women going through the divorce process and after, as well as widows, as well as happily married couples, where both parties are very much involved. So without further ado, I want to jump into our content because we have a lot to get through in, well, not that much time. We're going to be talking about the impact of the election on the markets. And we're going to be going through quite a few different areas. We'll be talking about the market impact, interest rates, inflation, mortgage rates, as well as personal and corporate taxes, and finally following up with what is the long-term view of the market. And overall, as we saw on Wednesday post-election, it was a decisive victory for Trump. It was very much sending shockwaves throughout the United States. And what the stock market did was essentially had a phenomenal rally. There's a lot of questions about why was the rally so sharp and so strong? Why is it continuing? Well, many investors expect that Trump's victory is going to lead to faster economic growth and more market-friendly policies, which essentially resulted in that market rally. And the stock market essentially brought in its verdict. The Dow leapt more than 3% on Wednesday and actually was on track for a record close. And part of the reason is the thought that Trump will lower both personal taxes as well as corporate taxes. But that said, the stock market tends to perform well no matter which party holds the White House. And the markets could be reacting with relief that this toss-up election actually really did produce a clear, undisputed winner. Many investors expect Trump to lead with faster economic growth and, as I mentioned, more market-friendly policies. And these are one of several reasons why, again, the market had such a strong and steep rally. So what happened with the market? I thought we would look at some of the different indices that typically are tracked to see which parts of the market were most impacted by the election. And as you see here, we have quite a few indices that are listed. The first is the S&P 500. The S&P 500 jumped 2.5% on Wednesday, its best day actually in nearly 2 years. Over the last 2 days, that continues to have additional gains. And what is the S&P 500? Because we talk a lot about it, but what actually is comprised of that index? Well, it's essentially a stock index that tracks the 500 largest companies that are listed on the exchange in the United States. So when we say the market, of all the indices, most people are referring to the S&P 500. Now, right next to it, we have the Dow Jones. The Dow Jones was up. It surged 1,500 points for a really nice gain of 3.6%. The Dow Jones Industrial Average, while a very prominent and well-known indice, only represents, listen to this, only represents 30 prominent companies that are listed on the stock exchange. So it does have a good benchmark of the market, but you can see it's only 30 stocks. It's not the full market. NASDAQ, which is one of my favorites. In fact, we just had the Savvy Ladies Gala 2 weeks ago at NASDAQ in the heart of Times Square. Well, the NASDAQ Composite Index also did phenomenally well, up 3%. And what type of company is listed on NASDAQ? Well, it's a grouping of more than 2,500 stocks that are listed. Most of these stocks are typically in the technology sector. So the NASDAQ index is very important, and again, has 2,500 companies, but no, again, it tends to have a tilting towards technology. Now, there's another index here that you probably are not as familiar with. It's one of my favorites. It's the Russell 2000, the little Russell 2000. But I'll tell you, it didn't have anything to do little with the gains that we saw. Nearly a 6% gain, posting in 5.8% at the day's end on Wednesday. And what is the Russell 2000? Well, it measures the performance of the 2,000 smaller companies. So as you look at these different areas, large companies that are listed on the S&P 500 versus smaller companies that are listed on the Russell 2000, well, which perform better? The smaller companies. Why is that? Because small companies tend to be able to react to policy changes that are more market friendly, more business friendly, a little bit more quickly than maybe some of the behemoths like a Meta, an Amazon, or a Pfizer. So that's why we saw a real unbelievable turnaround, particularly in Russell 2000. Now, Bitcoin has had quite a saga, ups and downs and all around, but actually Bitcoin surged to a record high. Why is it? Because Trump is very pro cryptocurrency. In fact, he has vowed to make the United States the crypto capital of the planet. And so in one day, cryptocurrency rose over 10% to a new high, well above $76,000. And what about the US dollar? Well, the US dollar is getting stronger and it surged. The dollar spot index, which tracks the US dollar against other currencies around the world, had a nice positive gain, almost 2% at 1.7%, essentially hitting our highest levels that we've seen in 4 months. So we talked a little bit about the indexes, but there was both positive and negatives for individual stocks. As you can see here on this next slide, you can see that there were a few stocks that did very, very well, and also some that did not. Well, Tesla, many people have heard about the very large support from Elon Musk, and he is set to be rewarded. And as such, many people feel that Tesla will have more favorable policies for the companies that he owns, such as Tesla, SpaceX, and the others. And because of this, the electric vehicle car maker shot through the roof at a 15% gain. JP Morgan also saw gains, but it wasn't just JP Morgan. It was, in fact, almost the entire banking sector. Why is that? Banks are poised to benefit from Trump's expected lighter regulation touch on them, as such, potentially looking at higher corporate profits. Well, Trump's own company, Trump Media and Tech, had a wild day on Wednesday. It spiked with a 30% gain, settling back down to, by the end of the day, at 5.9%. Still a very good day for any company, let alone on election day. And finally, Sonova. Sonova is a green energy stock, and this is one of the many parts of the market that didn't follow the gainers that we just talked about. In particularly, green energy stocks, solar-powered stocks had a tough day, and that is because Trump is seen as not as environmentally friendly and has very publicly spoken about potentially reducing the number of incentives and credits that are available for these green energy stocks, which unfortunately could affect their bottom line. So let's talk a little bit about interest rates. Just getting a little glass of water there. I hope you have a coffee or a tea as well. So interest rates are a big part of what's going to be very much something we need to pay attention to, not only over the next few months, but actually over the next couple years. All eyes were actually on the Federal Reserve just yesterday, and the Federal Reserve cut its target by 25 basis points, or another way to call it, 0.25%, moving interest rates down. It was a unanimous vote, and it was a statement that was accompanied by Chairman Powell saying that jobs have gone from slowing to just generally easing, which is a coded way of saying that the job market has improved. Chairman Powell noted several times that the committee is focused on returning to more normal, neutral interest rates. As we know, we are very much in the situation of very elevated interest rates. And they also mentioned now that they may not be moving forward with interest rate cuts as quickly as they originally had thought because of Trump's potential policy implications. They're going to be doing a wait and see approach, and again mentioned that they're a little bit more cautious about future rate cuts as they monitor the impact of Trump's economic policies for his second administration. So this chart talks a little bit and shows you the impact of interest rate cuts on inflation. As I mentioned yesterday, the Fed cut rates by 0.25%, 25 basis points, and that move follows an aggressive, actually half-point rate cut that occurred in the last Fed meeting in September. You'll go and see here, as you can look at the rate cuts there in black next to that September 2024 bubble. And then the other colors of green, yellow, blue, as well as red, showing you different inflation rates, different types of core PCE and other targets. Well, what you can see very clearly is that inflation has started to come down quite nicely. In fact, inflation was at 2.4% in September 2024, very close to what the Fed has said is their target rate of 2%. And while inflation definitely is decreasing, and it looks like we are back on track to more stable prices, it doesn't mean that the prices we're seeing today are actually going back down. Instead, what lower inflation means, it means that those prices that we see at the grocery store, it's just that they're rising more slowly than they had been. Inflation can actually really hurt, and it can hurt your bottom line. So how can the Fed use these tools to essentially control inflation? Well, when the central bank increases interest rates, borrowing becomes more expensive. We know that. You go to get a mortgage today, and we're seeing rates that we haven't seen actually in decades. In this environment, both consumers and businesses, well, we might think twice about taking out a new business loan, a car loan, or even a major purchase of a home. So, what this does in return is it slows down spending, typically lowering overall demand and actually over time, hopefully reducing inflation. And in this chart, you can see here that again, as interest rates go up, inflation goes down. All right, on the higher interest rates might encourage consumers instead to park more of their money also in income. We know this with higher interest rates today, right? Everybody has been benefiting from money market, high interest bearing accounts such as high yield accounts, giving 4, even sometimes 5% interest on cash. But on the flip side, lower interest rates can make borrowing, well, cheaper. That mortgage that you want to buy, that mortgage of that you need to buy that beautiful home, instead of paying something like a 7% or 6% closer to today, well, just a few years ago, you could get mortgages in the 2%, even the 3%. This is essentially stimulating the economy. People are more willing to borrow money and then go ahead and spend it. So again, lowering interest rates tends to inflate inflation, tends to put more money in the economy, more people buying things, more dollars chasing goods. So this is one of the ways, again, back to how the Fed actually controls interest rates to be able to control inflation. Well, this, while sounds wonderful, managing interest rates and inflation for the economy, it is a very delicate balancing act. It's trying to find a strike between interest rates that are high enough to keep inflation in check, but not so high that it's going to weaken the economy. It essentially talks about how to make sure that inflation is not running too hot, prices are not too high, and at the same time, we're not putting the economy by essentially overshooting and potentially throwing the economy into a recession. This is what the very difficult job of the Federal Reserve is, essentially trying to manage what you would call the tale of the Goldilocks and Three Bears. Essentially, the Fed, working in tandem with the government, tries to raise or lower rates by just the right amount, not too high, not too low, to strike that right balance of having the right employment opportunities available, so good job growth, but also stable prices, not having too much inflation. Well, this one you might wonder, how does sailing have anything to do with inflation? Well, it actually does. Just to show that relationship, this is my son who was back then 12 years old. He's now 18 and 6'3", but this was him in a photo on a sunfish, a small little sailboat, only about 82 pounds, and he is tacking. In sales speak, what that means is that he is turning. And what you can see in that picture, if you look really closely, his hand is gently moving the tiller with a very small little tweak. And because that sailboat is so small, it reacts very quickly, and then he could make micro adjustments along the way. Well, on the other side of the screen, you see Wind Shadow. That is our beautiful sailboat. She's a big one. She's 12 tons, so she's a little bit heavy. And that's me at the helm. I am tacking or turning as well. But however, because Wind Shadow is a larger boat, she is not quite as reactive as that little sailfish. Instead, she reacts much, much more slowly as I turn the helm. It's essentially delayed. And the reason why I am sharing this with you is that I want you to see how quickly that turn went with the sailfish. And also then the Beneteau typically takes a little bit longer. That's what the US economy is like. As the Federal Reserve tweaks the interest rates, we often don't see the impact on inflation for many, many months. And so again, that delicate balance between being able to raise rates or lower rates of the exact amount. So what will inflation look like under a new Republican administration? Well, it depends on who you ask. And according to the Peterson Institute for International Economics, they expect on the one hand that that Trump's policies could send inflation up as high as 6%. However, other analysts believe that his economic policies will end up being more watered down, and instead the impact on inflation will be much less, anywhere from 0.4 to just under 1% increasing inflation. Which will happen? Well, most likely it will be potentially right in the middle or on that shallower path. There will be some headwinds for the Trump administration. So also making sure that we don't find ourselves back in a situation where we have wild inflation as we talked about 1 and 2 years ago. So what will happen with inflation going forward? Well, most likely it will start to creep back up, but the Federal Reserve will be trying its darndest using interest rates to control those inflation numbers. And how are individuals feeling about the economy? Well, I have to tell you, not so good. 2/3 of voters surveyed after they casted their ballots on Tuesday told the interviewee that the economy was either not so good or poor. Their perception is not the full picture, but what it does tell us is that inflation is very much impacting individuals. It is hurting their ability to be able to pay for just even groceries or daily life. Individuals are very frustrated by the high prices. And again, although inflation rates have lowered closer to that ideal target rate of 2%, prices remain about 20% higher than they were before the pandemic. These high prices have frequently been cited as the reason many millions of Americans remain dissatisfied with an otherwise healthy economy. And you're probably wondering why I have a Central Park horse here listed. Well, something that I want you to take a look at, something that's unique and different about Central Park horses is that they wear blinders. They can only see really what's in front of them. It's to keep them from getting distracted to the right or left. Now, similar to this narrow view, many Americans see higher prices and are having a harder time seeing the overall improvement of the economy. Because by most measures, the economy is doing well. In fact, unemployment is at a historic low at 4.1%. The stock market is booming, and the country's gross domestic product, GDP, does still remain the envy of the world. So how is inflation making things difficult? Well, at the grocery store, prices are higher. Again, food prices in particular are up 25% since COVID, and unfortunately are continuing to rise. These consumer prices have surged faster than we've seen than any other time in more than 4 decades. And what I love about this chart here, and I'll give you a little second to look at it while I take a sip of water, I want you to look at these different items that you see at the grocery store and how from pre-COVID to today, the huge percentage increases in those prices have been. Which one was the highest percent increase? Take a look, take a quick sip of water. Did you see it? Yep, right there, eggs. I know you know that. Eggs were priced at $1.55 per dozen pre-COVID. Post-COVID, they shot straight up to $2.66, a increase, if you can believe it, a increase of 72%. A loaf of bread isn't cheap either. It was $1.27. It's gone up to almost $2 now, $1.95. So for the average American, while the overall economy is very strong, we do not necessarily feel it because when, again, we go to the typical daily buying groceries at the store, it's much higher. So let's talk a little bit about mortgage rates. Mortgage rates are definitely affected by interest rates. As the Fed reduces interest rates, cuts interest rates, over time, we start to see that mortgage rates also come down. This is in particular very important for individuals who are trying to buy that first home, or maybe you have someone who has a mortgage rate that they would like to refinance. Well, until rates come down, it can be potentially too expensive to be able to buy that first home or to be able to refinance your rates. And what we are expecting is that the pace of the interest rate drops by the Fed is going to slow. And as such, unfortunately, we don't expect that mortgage rates will have a huge reprieve from their high, rocket high levels that they are seeing today. Unfortunately, the Federal Reserve is more concerned and being more cautious about future rate cuts as they're continuing to monitor the impact of the economic policies of the second Trump administration. We now expect that there's going to be fewer rate cuts in 2025, and as such, these high interest rates that are hurting borrowers are not necessarily going to be going away anytime soon. So what are those high mortgage rates? Well, last week, the average rates were at 6.7%, according to Freddie Mac, and that is for a 30-year mortgage. Again, 6.7%, much higher than we saw 2 or 3 years ago. So what about personal and corporate taxes? Well, this is an area that has been hotly contested among the candidates, and we pretty much are, well, in agreement that the 2017 Tax Cuts and Jobs Act that was passed during Trump's first term will be extended. Originally, they were set to expire on December 31st next year in 2025. And a Trump win means that most likely voters can bank on the fact that these cuts and policies are going to be extended. This is part of the reason why the stock market surged so strongly after Trump won the election. Investors expect that he will have more business-friendly administration and essentially tax cuts not only for corporations, but also for individuals. As such, these tax cuts are expected to lead to somewhat faster economic growth in both 2026 as well as 2027. He's also floated potentially cutting taxes or even reducing and eliminating taxes for individuals who are receiving Social Security benefits. So another area where individuals could benefit having more dollars in their pocket. So what are the actual different items that are going to be potentially extended? Well, the current lower taxes that we are enjoying today will most likely, as I mentioned, be extended. And the standard deduction that you can see is essentially double 30,725 today is much more beneficial for individuals being able to reduce their taxes. We also expect that the 37% lower marginal tax rate of today will also be extended. For state and local taxes, those will be capped at just $10,000. The child tax credit, we currently enjoy $2,000 of a tax credit up from $1,000 before, again, expecting that that will be continued. If you're a small business, you're wonderful right now benefiting from a 20% deduction. That too is expected to continue. And then finally, alternative minimum taxes. The exemption for alternative minimum taxes is expected to continue to be that high, $140,300. And for those very wealthy individuals who were very nervous about the estate tax exemption being reduced to $14.3 million, well, they can sigh a relief because most likely we expect that A state tax exemption will continue at almost $30 million before a state tax kicks in, that at $28.5 million. So this is, again, the pre-TCJA and the post-pre-TCJA, which is the current. And my dollars is fact that the current will continue even after the sunset of these policies, December 31st, 2025. And so just as a recap, what does that mean? Well, we're expecting that these changes are going to be permanent, that income tax will be exempt from tips and potentially income tax exempt from even Social Security. We're expecting lower tax rates for corporations at 20% to continue, and something that's new, increased tariffs. Donald Trump, throughout his campaigning, has spoke about increasing tariffs, most notably on China, and increasing these tariffs to of upwards of 60%. So what will be the impact of these tax cuts on your bottom line, on your individual situation? Well, while Trump has promised to cut taxes across the board, what we're going to see is actually wealthy individuals are going to benefit a little bit more. On a pre-election basis, analysis from Penn Wharton Budget Model, it's a nonpartisan research company, a research project, found that middle-class families earning $81,000 on average are going to see their income go up by 1,700%, essentially a 2% increase. The analysis also found that as the income increased, people had higher tax savings. With those making $1.8 million, likely to see a gain of nearly $50,000 added to their income. And what this equates to is a 3% increase. So while both middle income and higher income individuals will benefit from these tax cuts, higher income taxpayers are expected to benefit more so on a percentage as well as dollar basis. So we just went through a lot. I feel like I need to take a break. I know I'm talking quickly because we have so much to go through. We've talked about interest rates, that most likely interest rates will be cut at a slower rate. We've talked about inflation, that it's going to be a little bit harder job for Powell and the Federal Reserve to keep inflation lower because of essentially tariffs causing goods and services that are being imported to be more expensive, causing prices to go up, and inflation also potentially going up because of more dollars in individuals' pockets from very pro-business policies as well as tax cuts. Finally, we talked a little bit about mortgage rates. Mortgage rates most likely coming down, but at a slower pace. And finally, I would love to talk about the long-term market impact. We all know what the market's done over these last few days. We've seen just a very, very strong rally in most parts of the market. However, what do we expect on the longer term? That's what we need to focus on. Not necessarily, again, what's in front of us today, but what is around us and in the future. So this chart is a little confusing, so I want to explain it to you. Each of the bars represent the return of the S&P 500 in the first year of an incoming president. So not all years, but just the first year. So what we're talking about is for next year in 2025, which is the first year that we will have our Republican president. The blue bars represent Democratic presidents, and the red bars, well, represent Republican presidents. On average, what we can see from here is that Democrats have returned a 20% return on average during that first year of the presidency. And Republicans have returned a 12% return during that first year of their presidency. And while you can see Democrats seem to have outperformed, I don't know of many investors who will complain about more than that, that 12% return. So overall, what this message is meant to be saying is that the market rally that we've been experiencing, based on history, which of course is not the determinant of the future, but based on history going all the way back to 1977, as you can see here in the chart, on average, a Republican president has been able to post a 12% return in that first year of their presidency, which would equate to 2025. So that's really powerful and important. Now, the next slide, I want to show you a little bit more about the impact of having a split government. Because for stock investors, the occupant of the Oval Office doesn't matter as much as the makeup of Congress. In fact, after all, just so you know this, the S&P 500 has gone up during 17 of the last 24-year presidential terms. Those are pretty good odds. But what the market likes best is it likes a divided government. And in this chart, you can see from 1949 to 2023, we see average yearly gains of 18.1% under Democratic presidents with a split government and 17.6% for Republicans. Split government, you can see that those are much higher. When you have a government that has the Oval Office, the House and Senate all Republican, you can see that we're looking at a lower average, about 10.7% there. It's really impossible to say exactly why stocks tend to outperform more under a divided government, which I talked about previously, versus a government where there is essentially no divisions. But overall, what we do know is that the market does not like uncertainty. The market does not like to have significant policy changes. And so as I see this chart, what it does is it gives me peace of mind, and I hope that it gives you peace of mind too, that no matter what party is in the Oval Office or in Congress, historically we have enjoyed very strong returns over a 4-year term. And the on average return each year over this next 4-year term, what this chart is telling us is that it's upwards of 10, even 11%. Now we know that definitely historical returns do not equal what's going to happen in the future, and we could definitely have a pullback. I wanted to show this chart because this chart tells us a little bit more about in history where those pullbacks have come from and how have we recovered from them. Stocks have and what we're seeing is that stocks have historically recovered quite significantly from major downturns, really delivering long-term gains. And you can see this very clearly going all the way back to 1980, looking at first Black Monday, then followed by the dot-com bust, Brexit, COVID-19, as well as Ukraine. These were all shocking events to the market. And while they had an initial quite stark reaction, we saw that the market came back quite significantly. In fact, in COVID, if you remember, as COVID really hit us in 2020, we had roughly a 30% decline in a matter of 1 month during 2020. But little over 2 months later, the market had recovered not only to where it was previously, but had extended beyond. And when all was said and done for 2020, 2020 posted a very positive year. So the short end of the story is that it's very important for us to stay invested. And let me tell you why. I love this chart, actually more than all of them. Here we see the growth of a $10,000 investment from 1980 through 2022. And if you invested this $10,000 in the S&P 500, you would now be sitting on over $1 million. Yes, listen to that. If you had invested $10,000 back in 1980, wish I had 10,000 back then, you would be sitting on over $1 million by just letting it grow in that S&P 500. But what is more powerful is the dramatic difference that you can see if you miss only a few of these days during the years. And you can see that missing only the 5 best days, so literally just 5 days out of the hundreds, thousands of days from 1980 to 2022, your return went down significantly. You lost over $4,000. And so, what do you take away from this? Well, the market's ups and downs are normal. And while I agree with you, they are stressful to watch. But what matters more is what we do with that information and how we react. And in my experience, disciplined investors who develop a financial plan and stay invested have typically better success reaching their long term goals. I have found that investors who keep waiting for that perfect time to invest or who try to time the market often miss out on gains over time and have much lower returns. Moving out and missing out. This is very clear that if you are out of the market for just 5 days, as I mentioned before, your return is drastically lower. And unfortunately, it happens to many people. They see a market downturn, it's fear, it's anxiety, and it's the escape to a place that's safe. And as many individuals we have seen do, will pull out of the market entirely, leaving that in cash and missing the rebounds. This was especially true in March 2020, where we saw such a steep losses of 30%, but a rebound that occurred in a matter of weeks. And those that had pulled their money out with the concerns of COVID didn't have their money back in the market to be able to recover those gains and essentially locked in their losses at lower values. A few more things here I want to talk about. Cautionary tale. It's a common reaction, of course, in times of market movements to pull your money out. But again, this here is another example of how pulling your money out does not help you achieve your long-term financial goals. All right, and one more. Thinking long term is the key to success. Staying invested in the market's ups and downs, it gives you a better chance to reach your long term goals. And so, what can you do to help you maintain that composure? Because maintaining composure is key. One of the most important things you can do is to make sure that you are set up to be financially secure. And the number one way you can do that is by having an emergency savings account. Knowing that you have enough money on hand to cover your essential, knowing that you have enough money on hand to cover your essential expenses and that you have enough money in case there is an emergency that crops up. That is very important and allows you to keep that longer term portfolio invested, working hard for you in the market, no matter what is going on in your personal life immediately. Also, I would consider dollar cost averaging. Dollar cost averaging involves investing a portion over time on a monthly basis on a regular schedule. And you're investing that, let's say, $1,000 a month, whether the market is going up or the market is going down. Over time, this can help individuals who are nervous about the market to be able to stick to their plans of investing, again, in good times as well as in bad times. Overall, we do know that people who dollar cost average $1,000 into the market over a year versus putting $12,000 on January 1st, well, those dollar cost average people tend to underperform. Why is it? Because if you're investing $12,000 the first day of that year in 2025, you're going to have all 365 days behind you where you can have gains. And 3 out of every 4 years, the market is positive. Whereas dollar cost averaging, while it can definitely reduce your anxiety, you're only putting $1,000 to work for you on January 1st and then adding another $1,000 on February 1st and like forth for the whole year. So again, it's a tool. but your returns typically are a little bit lower with dollar cost averaging. The final one is consider investing defensively. You need to know yourself. How do you react to market turbulence? How do you react to market volatility? If you are a person who is ready to go running for the hills when you see a steep decline, well, you may want to invest more defensively. And what that means is essentially having more cushioning in your portfolio. Instead of a 80% stock and 20% bond portfolio, maybe for you, it's better to have a 60% stock portfolio and 40% bonds. Some of our clients even have portfolios where they have 40% stocks and 60% bonds. So making sure that this portfolio reflects your risk tolerance. But the other very important thing to know is whether or not this portfolio produces the income, the dividends, and the growth that you need to achieve your goals. A very well written financial plan can do just that. That is one of our expertise in addition to money management and portfolio management, is creating a financial crystal ball, looking at our clients from today out to age 95 and beyond, helping them understand what their portfolio needs to do and how it should be invested. And finally, don't watch the market. Individuals who watch the market on a daily basis tend to underperform. Instead, get out there and live life. That is what it is all about. If needed, hire a financial advisor to help you if you do not feel comfortable on your own. And if you work with a financial advisor, or if you're a client of ours, reach out to us. That's why we're here. We worry and have the stress of the market on our shoulders so that you don't have to. So if you have any questions or want to learn a little bit more, please do follow us on social media, reach out. You can get us and stay connected with us. I just want to say a great big thank you. And today, I want to tell you that it was all about finances, and that's what the market cares about. It's not about my political affiliation. It's not necessarily about yours. The market just cares about, well, making money. And while if Kamala had been elected, we most likely would have seen a rebound as well. We're seeing a rebound, particularly for Trump, and it's truly because of the potential policy changes that he hopes to enact. The job cuts, the tax cuts that he has currently, most likely extending those, as well as more pro-business, where we expect that overall profitability for corporations, for companies, will be higher. Thank you for joining us here at Francis Financial to talk a little bit more about what a Trump presidency can mean for your dollar, your bottom line, both from inflation, price costs, as well as tax cuts, and finally also looking at what long-term investors need to know to make sure that you stay on track and you achieve your goals. Thank you.